Assalamu alaikum class. In today's lecture, we will be focusing on the preparation of a loan amortization schedule. A loan amortization schedule is a detailed table that outlines the repayment process of a loan over time. It shows each payment's breakdown between the interest and the principal along with the remaining balance after each payment. So this schedule is used for loans that are repaid in equal installments. Remember that all installments should be equal. So that this is used, this table is useful when all the installments are equal over a fixed period of time, such as in the case of mortgages, car loans, personal loan, or even in the lease. This schedule is very useful as it helps both the lender as well as the borrower to understand how the loan will be repaid over time. To work through our practice questions, we will be using Financial and Managerial Accounting textbook by Williams Haka Bettner, and we will be covering exercise 10.1 and 10.6 from chapter 10 Liabilities. So let's begin. I'm sharing with you the Excel sheet for practice. Here it is. So this is exercise 10.1. Assume that you will have a 10 years, $10,000 loan to repay to your parents when you graduate from college next month. The loan plus 8% interest. You can see the rate of interest is 8%. Annual interest on a unpaid balance. So this 8% will be applied on unpaid balance. Is to be repaid in 10 annual installment. Why 10 annual installment? Because interest is payable annually and the time period is 10 years. So there will be 10 equal installment, and you can see the amount which is 1490 each. 1490 each means the payment, annual payment, as we have just discussed, that this payment should be equal each year. So payment should be same or even. Now, what is required? Prepare a amortization schedule, and so there are few columns, year or the time period, or the you can say the interest period here. So 3 years schedule is required. To year one, year two, year three, only 3 years schedule is required. Here we have principal amount, principal amount or the amount borrowed at beginning, or you can say at the start of the year. Then we have annual payments, and this payment must be equal each year. Then we have annual interest, the next column would be repayment of principal or the amount borrowed. Then we have one last column, which is the balance of principal at end of the period. This is the balance of principal amount. So these are the columns. Here it is. It is clearly mentioned that the payment or annual installment are 1490. And we have discussed that these payments are equal each period. So 1490, 1490, and 1490. This remains equal or constant throughout the period. So the loan amount is 10,000, and this loan amount is before paying any interest. You can say this is column A, and this is column A. This is column B, and in column C, column C here. Column C is simply the rate of interest is 8% annual. So column A multiply by rate of interest, which is 8%. So in this case, column A has $10,000 at the year 1. So $10,000 multiply by 8%. So this 8% is the interest which is charged on the beginning balance of the principal amount. Here, now repayment, you can say this is column D, and repayment is calculated by the total payment, which is in column B, minus any interest expense, which is in column C. So you can say that 1490 minus 800. So this is 690 is the repayment of principal. So whenever you repay any amount of principal, then this amount will be deducted from the main balance. Means at the start of the year one, total unpaid amount of the note payable was 10,000. But at the end of the year one, $690 is paid from this principal amount, and this $690 is basically these dollar are part of annual payment. So the principal amount at the end of the um, you can say at the end of the year one would be here. I can this would be column E, you name it E, and this can be calculated column A minus column D. So here uh, we have $10,000 at the start of the month, and we have repaid $690. So the remaining balance is 9,310. So the ending balance or the remaining balance at the end of the year, at the end of the year one, would be the opening balance at the end of the year, at the start of the year 2. So this 9,310 is the starting balance or the beginning balance at the end, at the start of the year 2. So annual interest like this one, total unpaid amount of principal is 9310, and we multiply with the rate of interest, which is 8%. So the interest amount is 744.8. Now we are going to calculate repayment of principal at the start of the time period. Total annual payment is 1490, and we deduct the interest from this payment, which is 744.8. So the total repayment of principal is this. Basically this annual payment includes two things. One is interest on the unpaid amount, unpaid principal, as well as the repayment of the principal. So now we are going to calculate ending balance of the principal. So starting balance is 9310. We will deduct repayment of the principal, which is 745.80. So this is the ending balance of principal at the end of the year 2, which will be the opening balance at the start of the year 3, which is 8,564.2. Now again, we calculate interest expense. So unpaid amount at the start of the year 3 is 856 4.2, and we will multiply it by the 8 rate of interest, which is 8%. So this is the rate of interest. Now we will calculate the repayment of the principal. So total annual payments are 1490, and we will deduct interest expense, which is 685.14. So this is the repayment of principal. Again, the ending balance of the principal is from the beginning balance, which is 8564.2. We will deduct the repayment of principal, which is 804.86. So this 7,759, or you can say it is 60. This is the ending balance. So requirement was the prepare schedule showing unpaid balance at the end of the 3 years. So this is the 3 years repayment, and this whole table is called loan amortization schedule. And as I mentioned earlier, this loan basically showed all you can say um, payments, annual payments, and breakdown of this payment into interest and repayment of principal along with the remaining or ending balance. This is the remaining or ending balance. So this table is useful both for the lender and borrower to understand how the loan will be repaid over the period of time. Now we have another example. This is 10.6 exercise from the same book, and we have different data. So let's get started here. Total amount borrowed is $1,50,000, and this amount is payable monthly. Um, and the monthly installment is 1543 and the annual interest rate is 10%, 12%. So this is the annual interest rate, and we are preparing loan amortization schedule monthly. So this 12% would be divided by 12 months. If we divide 12% by 12 months, we will get 1% per month. Loan amortization schedule is required for two monthly payments only, for two payments only in requirement A. So we are going to prepare the same schedule as we prepared in the last example. We may copy the table for the sake of simplicity. Here we have this table, and we are going to paste it. This is requirement number 1. So the total amount that we have borrowed, the rate of interest is 1% per month, and it is not year. We are going to make the table monthly. So these are month, 1 month, 2 month, 3 month, and so on. Total money which we have borrowed is $1,50,000 at the start of the month. Total monthly payments are given 1543. So 1543, and just two months payments are required. So we are going to delete it. 1543. I have mentioned it earlier that annual payments would be same. Annual interest rate now unpaid amount is 1,50,000 multiplied by monthly interest is 1%. So monthly interest is 1500. In year one, we are going to calculate repayment of principal. So total amount is 1543, or the total annual payment, total monthly payment is 1543. We will deduct monthly interest, which is, so repayment of principal is just 43. It is monthly. And here again, we have monthly. So the remaining balance is 1,50,000 minus repayment of principal is just 43. So this is your 149.957 thousand is your closing balance or remaining balance at the end of the month one. So the balance which is at the end of the 1 month would be the opening balance, or you can say the balance at the start of the month two. So this is 149,957. Monthly installment is same, and we are going to calculate interest rate, interest expense. So 149,957 multiplied by 1%, which is 1499. So it is almost same, around $43. The repayment of principal is almost same. How? You can see 1543 is the total monthly payment, and we are going to deduct 1499.57, which is the interest expense, monthly interest expense. So again, we get 43.43. So the closing balance would be 149,957 minus 43.43. So here it is the closing balance of the principal amount. This was requirement one. In requirement two, prepare the journal entry to record the second month payment. Second month payment. So we have this amount for the second month payments. So we are going to pass the entry in second month payment. We have interest expense. So expenses by nature debit. So we have to pay interest expense, or we have to record in the debit column. Then we have a credit column. So interest expense, here it is the column of interest expense, which is 14.9 for 1499.57. So we can say this is around $1,500. $1,500. Then prepayment of principal is also there. So mortgage payable, which is repayment of principal, which is $43. 43.43. For here, this amount is exactly 1499.57. And so take the amount till two decimal places and the total cash paid. So cash payment, which is your second installment, 1543. So 1543 is the installment. So here you can see that we have prepared a loan payment schedule in which the payments or the monthly payments or the annual payments are same, it will not be changed. And then only the interest expense and repayment of principal changes, but the total of these two will always be same as monthly payment. So that's why in requirement C, they have asked, will monthly interest increases or decreases or stay the same over the life of the loan? So you can see the monthly interest payment is decreases in future. Uh, uh, why? Because the principal amount is also decreases. So we apply the rate of interest on the unpaid balance of principal amount. So unpaid balance of principal amount is also decreases. So that's why interest expenses is also decreases. You can see first year, the unpaid amount of loan was 1,50,000, whereas second month the unpaid amount was 1,49,957. So because it you can see the 43 dollar is the repayment of the principal. So unpaid amount of the principal is decreasing month by month. That's why interest expense is also decreasing month by month. So this is the answer of requirement C. So that's it from this lecture. Take care, class.